From McGuireWoods, welcome to Yield Maintenance, a debt finance podcast for market participants outside the traditional bank lending space. Whether you're a direct lender, an alternative lender, in fintech, or a borrower, we invite you to come inside the conversation with the specialists and professionals of the debt finance industry.
Hello, and welcome to the latest edition of Yield Maintenance, a debt finance podcast produced by McGuireWoods. This is Brian Coughlan, your host for the podcast, and I am joined today by two partners, David McLean, who is a private equity partner in our Dallas office, and Ann Croteau, a private equity partner in our Raleigh office. We're excited to have both of them on to discuss the ins and outs of mezzanine financing and how that particular segment of the market has been affected by the recent changes due to COVID and potential opportunities in the future. Hi, David. Hi, Ann.
Hey there.
Hi. How you doing?
Good. Glad to have both of you on the podcast today. We have some pretty interesting topics to discuss, and we're going to dive into the intricacies of the mezz and second lien market, which is an area where non-bank lenders have had a significant opportunity to expand because banks are typically unwilling to go into that particular market. So kind of interested to hear about your experiences in that market and what you're seeing particularly in the last couple months as the markets have generally been pretty disrupted overall. So David, at a 10,000-foot view, do you think you could provide kind of a general description of what a mezz facility or a second lien facility looks like, and when a borrower might look to utilize a mezz or a second lien facility as opposed to a traditional kind of senior secured single bank or syndicated structure?
Sure, happy to. And, in some respects, while this has been evolving and changing over the years, in some respects, it's been a really, really slow evolution. And you can go back, 10, 12, 15 years whenever I really first started doing this and would run into Ann at each of our prior lives or prior shops, and we're doing this work. It hasn't changed that much. For years, there was and there still is today a large, conference in New York every year on the state of the mezzanine market. Now I think it's the state of the mezzanine and unitranche market, but the group would do a market survey every year, and it seemed that you could literally just take the prior year's survey on terms and structures, and it didn't change very much from a pricing and structural and identity standpoint as what those deals look like. That is, sort of the typical 12% cash pay interest, 2% PIK was just sort of the market for the longest time. That's where I think the biggest evolution has been on pressure on that pricing. But just a general description of the mezz market. I mean, I remember when I started doing this work about 15 years ago, went to a firm that we'd heard had a heavy mezz practice, and honestly, at that point, I didn't even really know what that meant. It truly means what it sounds. It's a level of finance in between the true debt and the equity. So think of it as a junior security that sits beneath the senior debt facility, often utilized because the senior lender's appetite or credit profile only allows them to go up to a certain leverage ratio with the company, most typically a 3 times if a bank has mandated. So usually that mezzanine facility is coming in to provide extra capital to a company, oftentimes for a leverage buyout, and it sits above the equity in that capital stack and beneath the senior debt. Mezzanine, we think of it more as a product as well as a structure, in that with institutional mezzanine lenders, there are very well-defined constructs. I never refer to them as market terms when negotiating, because they're so ingrained and settled in this product that they're really constructs of what a mezzanine facility looks like with an institutional mezzanine lender. Limited duration payment blocks as opposed to permanent payment blocks for non-payment defaults. It's a very critical distinction from deep subordinated, quote unquote, seller debt or seller paper. Limited remedy standstill periods as opposed to a permanent remedy standstill period on taking unsecured creditor action. Very well established provisions that govern in a bankruptcy vis-a-vis the senior lender. And a few other sort of critical sacrosanct terms that give that mezzanine lender sort of clarity on what the relative rights between the two lenders, the senior lender and themselves, if in a downside scenario, in much different world than the junior lender, the seller paper, or in the venture context with convertible subordinated debt that might be provided by the equity investors, where it's more of a it's called debt but really looks more like equity. Second lien facility, again, and I think you're going to hit this with another question and can get more into this. But when you talk about second lien, it depends on if you're talking about structure or a product. From a structural standpoint, again, this is probably one of the evolutions I've seen and we've seen in the mezz market in the last 10 years. When I first started doing this, 2005 timeframe, almost every deal that I worked on was an unsecured mezzanine facility. No security interest in the underlying borrower's asset. Maybe a pledge of key man life insurance, maybe a stock pledge. That sort of evolved over time to now almost every deal that I work on is a secured mezzanine transaction. And from my perspective, I think some of that came about as, there started to be a proliferation of second lien deals in term B, sort of quote unquote term B facilities, around that, started to pop up around that same time. And I think the mezzanine market kind of glommed onto that secure notion, oftentimes as a quote unquote silent second, which could have many different characteristics in that realm. From a structural standpoint, a second lien facility and a secured mezz facility is the same thing with respect to its own paper. It is a junior debt facility it is a debt facility that is secured by the company's assets, junior and lien priority to the senior lender. From a product standpoint, very different. That second lien market is only subordinated by lien. There's no, while they get paid second in a waterfall, there is no sort of notion of a payment subordination or a blockage concept where the senior lender can shut off payments to that second lien lender. It's merely a lien subordination concept. In the mezz space, the characteristic of having a security interest on the paper doesn't really change that dynamic that you would have with an unsecured deal, which is, senior default payment. There's going to be a permanent block until that payment default's cured. Non-payment, financial covenant, a limited duration payment block. So a lot of words there, but that's a brief peek at the sexy world of mezzanine finance.
Yeah, no, I think that you joke, but mezzanine finance is actually, I feel like it is a bit of an opaque area of the market until you really start to dive into it. Yeah, the market terms they do seem like there's a general consensus a little bit, but they do vary pretty significantly by the actual mezz lender that's involved, particularly if they're going to take a strip of equity, because that does kind of change the profile. So, Anne, David mentioned the difference between a mezz lender and a second lien lender. Do you find that you come across institutions that operate both as mezz lenders and as second lien lenders? Or is that a pretty distinct market? And we see a mezz lender operating in one area, a second lien lender operating in another area, and those really acting as very different products, even though the terms may be thrown around as if they're analogous.
That's right. They are thrown around in the lower middle market often as if they're analogous, but at the most precise, they're totally different and totally different products. I think the reason they're thrown around in the lower middle market as analogous is based on, what David said, that mezz lenders, the traditional mezzanine lending really started in real estate and then moved into the corporate, debt market and initiated really as unsecured financing, initially offered by life insurance companies. And that is the true mezzanine product or financing is really unsecured debt. In the lower middle market, a lot of mezz lenders over the past decade or more have moved to taking that second lien. As David said, that second lien really probably isn't fully collateralized or even, much collateralized at all in certain circumstances. And a lot of the reason the mezz lenders started taking it was really to get protection in a bankruptcy proceeding above the unsecured and the trade creditors. And that's the primary reason why they they do hold that lien. It does also give them some ability to take secured lender remedies, which actually can be important in certain restructurings. There are times that the first lien lender doesn't actually want to take the remedies, particularly if it's a small revolving lender out in front of the mezz. I've done transactions and restructurings where there is a sizable revolver and first lien term loan, but the bank, often a bank, the first lien lender may not be, but often the bank doesn't want the risk of taking the secured lender remedies and has authorized the mezz lender to actually take those remedies themselves, which is typically understanding that under the terms of any intercreditor, the first lien lender is going to be repaid first. And there would be, as David mentioned, some sort of standstill, often about 180 days on a mezz facility. And they would require the consent of the first lien lender typically to take the kind of remedies. But we've done that from a junior position, taken over a company, taken over the board, and continue to operate it and sell it to pay off the first lien debt. So that's a little glimpse on true mezz. Second lien tends to be further up the market. It's not typically in the true second lien, is not in the lower parts of the middle market. It does not come with typically payment subordination to the first lien lender, as David indicated, and it's generally reserved for companies that have a sufficient EBITDA generation, enterprise value that the first lien lender feels comfortable not requiring payment subordination. There are times that, and so the products tend to be generally offered by different lenders, especially, when you're talking about mezz, unsecured or secured, but, typically as we would see in the lower middle market now, secured mezz being offered typically by smaller debt funds, lots of SBICs, small business investment companies in that world providing that product. And second lien lenders tend to be still often a private entity, but funds of much greater size that would be offering the second lien product.
And Brian, probably the biggest difference in the two products and the way to really identify what it is beyond the payment subordination notion is pricing. The second lien is going to be priced, again, given its slightly less risk profile, differently than that mezz product pricing.
And that largely relates to the area of the market in which they are actually financing. So absolutely, the more you move up market, typically the lower the pricing goes, because also when you're moving up market as a second lien, in a second lien product, you're also starting to bump up sometimes against the high yield bond market. And of course, that's going to be far preferable to the borrowers in terms of having far more flexibility.
Yeah, I was about to mention that if you're listening to this podcast and you're playing in a private equity world or a financing world, that's middle market, up market, you probably haven't even seen, I have colleagues, law school colleagues in New York that do nothing but high yield debt offerings, and they really don't even know what a subordinated debt, a mezz transaction looks like. They've never even come across it. They're sitting much larger in the capital stack. Where that high yield cutoff, you really start to see it, at least from a facility size standpoint, when you start talking about $7,500 million mezz facilities and start getting up there in size.
Yeah, I mean the pricing involved in mezz would make it. Well, it would make it very expensive if you started to get into a very large facility. So yeah, if there's another alternative that's cheaper, I think everybody likes the cheaper alternative, especially when it comes to financing. So I wanted to switch gears just a little bit to a more personal topic for both of you, because both of you are a little bit unique in that you are both, I would describe as robust M&A corporate lawyers, but you also practice in the debt space representing mezz lenders, which in all honesty is extremely unique. So how did you end up both having a traditional M&A practice and a debt finance practice, which are two hats that most lawyers don't wear?
The way it happened for me was I started out an M&A lawyer, a complete M&A lawyer, practicing in Chicago and then New York, running largely strategic non-private equity buyouts and strategic acquisitions initially, often between public companies, public company mergers. Did that for about 3 years, moved to New York. And at that point, I did start doing some private equity buyouts, but from the M&A side. And my extent of understanding any portion of the debt finance was who in the debt finance group I needed to call to make sure the financing was going to be ready when I was ready to close my M&A deal. So I did that for about 6-7 years. And then when I burned out New York, moved to Raleigh, which is obviously where you move after leaving New York. And at that point, moved to a smaller shop here where I was still doing M&A, but was required to do more all around the axle. And this firm had a mezzanine practice, and so I started learning debt finance, and it was an interesting switch to me. In part, the M&A documents are all past looking, reps and warranties about what everyone did in the past, and it kind of speaking as of a static time about what the buyer's going to get going forward. Whereas with debt financing documents, they do have that representation warranty portion, but they're really far more forward-looking documents about the covenants, affirmative and negative, that the buyer was going to have to abide by to make the lender happy and feel secure. So I actually thought it was fascinating in that regard, and what I liked about the mezz market and debt financing as compared to M&A initially was the fact that you're brokering this relationship going forward. In M&A, sure, you could have some transition period, and of course, with a private equity buyout, often you have the selling shareholders roll over and stay in some sort of operational role. So there is a little bit more of that relationship continuing on. But compared to the bigger M&A that I was doing, the more strategic, it was, you're doing a snapshot in time, everyone parts ways, and you hope you don't see each other again because that means you have indemnity claims. Whereas it was kind of fun negotiating with folks that were going to have to live, eat, and breathe together for a while. And I did find that understanding the debt financing and also equity financing that go with a leveraged buyout, in addition to the M&A, I think makes me a better lawyer personally, being able to see everything all around the circle and understand how some issue in the debt financing could actually implicate the M&A. So that's kind of my spiel.
Yeah, I would say that the Chicago to New York to Raleigh route is a very typical route for most lawyers. So
Exactly. It's a little bit odd, but we liked the barbecue here, so.
Fair enough. David, what about you? How did you end up doing both that and M&A?
Yeah, so it was fascinating listening to Ann because, Ann and I did deals opposite each other at our prior firms and always had great respect for Ann because she was honestly the only other lawyer I ever came across that had that similar joint expertise and background in working on both the M&A side and the debt side, and I never really knew how she came about that as well. Very similar, and she talked about the distinction in sort of on the debt deals and the go-forward relationships. I'll turn back to that because that's been a key to my practice and how I got into this. But, I started in New York at a big firm at Cravath, Swain & Moore, and their model is to rotate within, practice groups every 12 months or so that in theory you make partner 7 years and, you've given up 20 years of your life. You look much older, but you're an expert in 7 different things. You've done nothing but high-yield debt offerings for 12 months. You've done nothing but M&A deals for 12 months. You've done nothing but IPOs for 12 months. So I went through a couple of rotations and always and had it in my early DNA to sort of try to be a jack of all trades and learn multiple things. So I did everything from M&A to public offering work to a lot of structured finance, aircraft leasing, muni work, collateralized deals like the DreamWorks facility when that was put together. So I had a background in doing more than just one niche. When I moved to Dallas, really kind of settled on being an M&A lawyer and moved to a firm, and I can say it because they're not in existence now, Patton Boggs back in 2003, and was hired with a group of 3 lawyers who were left from the Dallas, Brobeck, Flager, and Harrison office. And a lot of lawyers, people don't know that name now, but it was the high-flying tech firm during the dot-com bubble. It was, the 1A or the 1B to Wilson Sonsini and Cooley and Gunderson and some of these other firms. And so we were doing a lot of venture capital. So joined Patton Boggs with a small team, really with one other, I think we were 7th-year associates at the time, who ended up being one of the partners who founded McGuireWoods Dallas, along with me and a few others, Akash Sethi. And we joined to build out the private equity group for Patton Boggs. They were a practice that was doing a lot of, it was a debt finance shop and a lot of junior capital, a lot of mezzanine finance. A lot of their clients at the time, the partner that ran that group, was really forward-looking, and he saw the evolution of the market coming. He saw a lot of his clients starting to move up and down the capital stack, taking more control positions, a lot more significant equity co-investment. Warrants were sort of phasing out. They really didn't have anybody at the shop who had expertise in negotiating those minority equity rights, whether it was direct equity or a warrant or even, control deals, which some of their clients were doing. And so we came out to build that M&A group, but initially coming over, there was not enough work for 2,000 hours for each of me and Akash. And this mezzanine practice was thriving. It was sort of described as a distant cousin to venture capital, which is really, really true, right? A lot of the same, all the equity docs were on the same template. It was just a matter of kind of learning the debt piece and understanding the covenants. And the beauty of the mezzanine work is, you're largely working off of the senior documents. So it was a good way to really learn that product without completely being thrown into the fire. It was put on a deal for Norwest Mezzanine Partners, which is still a client today, and kind of learn my biggest lesson, from the very first phone call, learn my biggest lesson into being, I think, a strong lawyer in the space, which was they were financing a buyout for GTCR out of Chicago. That's my second story. They were financing a buyout for Sentinel Partners out of New York. It was one of their first ones, very, very important strategic relationship with them, sponsor relationship, and was told, listen, our relationship with them is critical. We have to, advocate strongly for our position, but, make no mistake about it, the other side is our client. And so really learn that very on that when you're representing a mezzanine lender, the borrower is your client's client. And playing nice in the sandbox or having a collegial attitude and a cooperative attitude, however you want to describe it, it's critical. And so closed that first deal, and whenever they went back, when Sentinel was doing their next buyout and Norwest was selected, they asked that I work on that transaction. And, then transaction 3 happened, and that it became part of the team. Similar thing happened with the American Capital Strategies Chicago office, which is now the Mezzanine team out of Chicago. They were financing their first GTCR buyout that I, kind of jumped to. Again, a big win for them and critical because the goal wasn't to do one GTCR deal and hammer the hell out of them on the documents. It was to be a good partner and do, a dozen transactions. Same thing happened, closed the deal, great experience. When they won a mandate to do GTCR's next deal, GTCR specifically asked that I work on the deal for them. That's how I became a mezzanine lawyer, and 2 clients turned into 4 and 4 turned into 8. Fortunate that the senior partner at Patton Boggs Dallas, and a couple partners there were comfortable with me sort of getting involved in those relationships. And then, as typically happens, somebody left American Capital Strategies and went into a large hedge fund that had a senior strategy that was starting out on their direct illiquid credit group, and morphed and became doing more, first lien senior work for a private debt fund, and then that grew. So that's how I became a debt lawyer, and I just never stopped doing the M&A work and the private equity work. So over time, my practice became, I always like to kid, I'm up and down the capital stack. I started doing everything from representing, early stage equity investors, growth, venture capital, growth equity investors, control buyout funds, and then I added in the practice representing first mezzanine junior capital lawyers, whether it was unsecured mezz, secured, second lien, PIK holdco structures. Started doing the senior work, and then picked up, started doing venture lending, which was, the sister to venture capital, but on the debt side. So to this day, really, do it all. Some years it's 80-20 one way, some years it's 80-20 the other. In an ideal world, it's 50-50. What I learned is by having that diversification, your value tends to continue through the downtimes, and you can always tend to find ways to keep yourself busy, which plays out well during a time period like we've been going through with the last 3, 4, 5 months, as the, largely, with some exceptions and some pockets of people, that buyout world is kind of ground to a halt for certainly any kind of new deals. Looks like it's starting to thaw now, but just, handling the debt work and primarily the portfolio company work for the 100+ loans we've closed over the last 4 or 5 years, threw off a stream of work that keeps you employed and keeps you as a value add attorney. So it's whether by luck dumb luck or blind luck, it worked out well for me. And to this day, I, kind of see myself as a up and down the capital stack private equity and finance attorney.
Yeah, I would claim that is definitely design and not luck, but that's a pretty fascinating path to get from where you started to where you are today. And I think it's actually a pretty good transition because you mentioned that the acquisition market has really slowed significantly. And I think anybody who does M&A work, even from the financing side, has known that there is some M&A activity, but it's significantly slower than it was going back to February. And while we'd like to see it starting to thaw, it seems like it's a little start and stop at this point. So, Anne, what do you think the current state of the mezz market is, especially considering that it is so tied to the acquisition market and LB? Yeah. And so what are mezz lenders doing? Are they deploying capital? Are they sitting on capital? Are they finding other ways to try to deploy capital? Or what have they been doing while the M&A market has slowed?
Well, I have not seen as much capital deployment in the last several months because, as you note, they are largely financing M&A buyouts. And the other thing that the mezz market will also do, in addition, I think the majority supports leveraged buyouts. However, there are a number of mezz lenders who are providing growth capital to companies that are not changing hands. And that growth capital is usually some hybrid of, mezz and equity, often some sort of a warrant, although those are harder and harder to come by these days in the mezz world. They're often having to pay for their equity or at least some portion of their equity. And so some of the term sheets that I am seeing more of relate more to the growth capital that an ongoing business requires in the lower middle market. And I am still seeing some of those floated did actually close a transaction that originated post-COVID and closed about 2 weeks ago, and it was that growth financing. It's pricier right now, and part of the reason even the growth capital is not moving forward significantly is because people are looking to make sure that the companies are stable. So basically there are a handful of industries that are, I think, still considered to be kind of good bets at this point that have not been as impacted by COVID. Clearly, it's quieter. The other thing, and this gets into the next question, I believe, so I don't want to go too far down this path, but often when a company is in trouble, everyone looks around at the mezzanine lender to solve the problem, to solve the liquidity problem, because the discussion usually starts out with, the equity sponsor or the CEO of the company asking the first lien lender, hey, can we get some more room on that revolver, or can we do a small term loan or maybe a CapEx line, something with ideally the sponsor would want the first lien lender to provide it at that pricing, which is going to be far more favorable. And if the company is in trouble and with liquidity issues, occasionally the first lien lender will throw a little bit of, cash their way or a little bit of flexibility. But for them, if it's a big stub that's needed, usually the first lien lender says, not my problem. I don't feel appropriately collateralized right now based on how the company is performing. Why don't you put in equity? And then the sponsor says, no, I don't want to actually put in equity because my equity is, if you're not even appropriately collateralized, my equity is totally underwater. I don't want to do that. And sooner or later, everyone's fingers start pointing to the mezzanine lender who has a decision to make at that point about, what is the status of the company? If they step up and provide this liquidity, are they throwing good money after bad? And more often than not, the mezz lender often does put in some slug of liquidity to help move the company forward and protect its investments. Often, if they're willing to do that, they might at that point get a kicker or some sort of equity kind of upside for the risk, the additional risk that they're taking on now to step into that void and provide that liquidity. And that I do see some of that ongoing now. I see those discussions ongoing. I'm working through a restructuring right now where the mezzanine lender is going to be providing, several $1 million of significantly needed liquidity. But there is not as much happening even in the restructuring in the liquidity kind of plug world because of the government loans that have been provided. So right now, a lot of companies are able to function off of, the government loans that they've received or are going to be receiving. And I think the real question is going to come with what happens when that money runs out. And if the company has not recovered and is not performing appropriately, I think you're going to see a lot of finger pointing at the Mez.
Yeah, and as that stimulus funding starts to run out, I mean, I think it's an open question at this point whether or not there's going to be more stimulus, and that really kind of feeds right into the next question. So the government-sponsored stimulus programs, the Paycheck Protection Program and the Main Street Lending Program, don't allow non-bank lenders, with very rare exceptions with respect to the Paycheck Protection Program, to participate as lenders in those programs. And they will not be allowed to participate as lenders to the extent that they're not banks in the Main Street Lending Program. David, how has that limitation affected Mez lenders, given that they don't have the ability to provide these loans because they're just not part of the program? And how has it affected their existing portfolio of investments?
Sure. On the first part of the question, I don't think it's affected them much, just because the nature of these programs and the pricing is just something that these private, wasn't going to generate the necessary IRR to satisfy their investors anyway. I think largely these loans have been sort of a fee game, sort of twofold: a fee game for the banks. A tremendous amount of fees have been generated over it, and it's also been a lifeline to customers of the banks, where they probably otherwise have senior debt exposure, to, as Ann said, kick the can down the curb and keep some of these companies from going into significant distress or bankruptcy. Again, we're talking the lower middle market. We're not, you can open up the Wall Street Journal and see every day some sort of BK filing for something that's tied to the retail industry. So I think the bigger impact has been the second part of it, which is on, well, I think the impact has been more, again, to what Ann said, and it says some of the stimulus capital has come into these companies. It's put off a bit the need for perhaps these borrowers to do something. I think as that money where it runs out and is spent, the nature of these companies in the lower middle market is these aren't, these are typically 10 to 100 million enterprise businesses. They're, 1 to 10 million in EBITDA, 1 to 15 million in EBITDA. These companies aren't sitting on huge amounts of cash. They don't have, inordinately large senior debt facilities and revolvers they can draw on. In a lot of respect, what's happened in the last 6 months is the growth trajectory of these businesses has been thrown off the rails. The ultimate exit of these companies is to grow to a point and then exit. And I think in order to get back on that trajectory and that path, looking to take largely non-dilutive capital to do so is going to be very attractive. So I think it's delayed in somewhat the deployment of capital from these private, junior debt funds, but I think it's going to accelerate and quote unquote be caught up, if you will, over the next 18 months. I'm starting to see it thaw. When you reached out to me a week or two ago about this, and I mentioned that, for the state of the market, I'm just going to play an audio file of crickets chirping because I didn't have any news going on. I've had 2 pop up since then, but from quote Mez funds, but neither deal is a quote unquote Mez deal. They're both senior. One, relying a little tiny little working line of credit on top of it, but they're in effect first lien deals, both of these transactions. So I think that speaks to one of the characteristics of these mezzanine funds or junior capital funds, is they really have flexibility to play up and down the capital stack to deploy everything from preferred equity, common equity, preferred equity, PIK holdco, unsecured mezz, secured mezz, first lien, synthetic unitranche. The players that are most successful have the ability to be flexible in their mandates and how they deploy capital to bring returns to their investors. I think the impact that's occurred, and I think, again, to Dan's point, where a large part of the capital is deployed for financing leverage buyouts, I think that we'll see, I think what we're going to see more in the next 18 months is perhaps a move towards just, growth financing, growth mezz to get back on that track. Maybe owners do take a dividend recap to bring some liquidity to themselves because they were used to pulling out distributions from the business that have dried up. So I think the mezz funds are perfectly situated to step in and fill that void. And again, Dan's point, I think the strong businesses are going to, right now people are seeing what those businesses are. And those ones that are self-identifying as strong and sound are going to come out of the strong and sound, and the capital is going to be there to finance them. These funds, whether it's buyout funds, growth equity funds, or debt funds, are not sending money back to their LPs. This vintage that we're seeing is that the capital is going to get deployed. It's just going to be compressed into a shorter period of time, and whenever that switch gets flipped on, and again, we're seeing a little bit of a thaw of it now. I think you'll see that very, very active. The last piece is a lot of what the mezzanine funds, particularly the SBIC funds, have been doing the last 2, 3, 4 years is financing the independent sponsors in their buyout activity, which has been, one area where we've been, fortunate to kind of, be at the forefront of. While certainly that space has slowed down as well, and this, will probably shake out some of the stronger independent sponsors from others. I would say our network of independent sponsors, while I think the number of deals close to LOI or what's floating around is much slower, they're all really out there actively looking for those strong opportunities. I think that, they were able to more quickly flip the switch to looking for acquisition targets than their committed blind pool equity fund competitors have been. In other words, when this hit, right, every private equity fund and every debt fund in the country spent the first 60 days just putting out portfolio company fires and making, plugging holes in dams and making sure their portfolios weren't just going up in flames. And that took, 1, 2, 3, 4 months. And it's only been in the last 4, 6 weeks, I think, that's kind of under control. Forbearance is put in place, restructuring is put in place, and the groups can really kind of start focusing on new activity. The independent sponsors really never really had to deal with that too much, at least the new ones. Or if they did, maybe they had 1 or 2 portfolio companies as opposed to, 5, 10, 15. So I think you'll see those groups emerge with new deals a little quicker as a result, because I think they had a head start in looking at deals, and those deals fit very favorably with those private debt funds, the junior capital funds, and again, accelerated by the fact that a lot of the banks that would be taking a piece of that for the same reason maybe aren't able to go out and deploy capital because they have issues with their portfolio companies, that run into, have more regulatory pressure than the private debt funds do.
And I do think where you're also going to see, it's almost like on a barbell approach. Not only are you seeing, the companies that are performing well during this pandemic being, potential targets, but folks are starting to look, most particularly some of these private equity funds, the funded capital funds. They, like David said, they were mostly putting out fires, but now they're starting to look at the potential distressed targets, particularly as tuck-in or add-on acquisitions to an existing platform, because there's a potential good buy out there. And if people are seeing the market and the companies stabilize to some extent, they're having a little bit more confidence to start putting out LOIs to basically snap up what they see to be a good bargain. And a lot of that is going to be financed by the mezzanine lender already in that cap structure, because the bank is not necessarily going to be willing to fund it, or fund much. They may open up a little bit of their financing, but there's going to be a real need for the mezz to supply, I think, a vast majority of that pricing. And as David mentioned, what we're seeing in terms of the growth capital coming out of the mezz market right now, it is often in the form of a first lien or kind of unitranche financing, but it's priced like mezz. It looks and quacks like mezz. It happens to be only behind a small revolver, secured only on current assets, was the sole source of debt capital to a company. And so you can tell that obviously people are having to pay a lot for the debt financing they're getting right now, and it'll be unclear when the banks, apart from the government stimulus programs, really feel comfortable putting more liquidity and more capital out there. I think for a period of time, you're going to see the mezz market really be the supplier of that capital.
Yeah. And related to that, do you think, and I mean, David mentioned that he sees mezz capital being provided in a number of different potential products. So traditional mezz, PIK holdco notes, more traditional growth financing, or almost venture debt sort of products. Mm-hmm. Do you think that there's going to be pressure on kind of traditional mezz lenders from either their investors or LPs to move into different product lines, or to push capital out back into the market kind of earlier than everybody has anticipated? Or do you think that that's going to be kind of a natural evolution of the product, that there are going to be opportunities available for kind of the traditional non-bank lenders to really seize market share while the banks sit on the sideline?
I think you are going to see a decent amount of that happening, and that was consistent with coming out of the 2008-2009 recession. I think it was 2009, we saw very little bank lending going on, and the mezz market was really, the mezzanine lenders were kind of running the show, and that started to turn in 2010, but there was a period of a good 12, even 18 months, declining over that period where the bulk of the financings in the low middle market was coming as mezz or with mezz pricing. And so I do think you'll see you are seeing that same phenomenon happening here. I think you'll continue to see that. I don't know how much it's coming from the investors and LPs pushing the actual fund to be out there. I haven't heard or seen as much of that apart from the principals of the mezz fund want to be out there and want to be pushing this money forward. They do have a lot of these mezz funds, especially, the SBICs. They may be sizable funds. They may be raising somewhere between 35, 50, 70 million of their own capital that can be matched up to 2 or 3 times by the government, depending on their registration. But they're not billion-dollar funds. They're not $500 million funds. And so they have a little bit more ability to sit on the sidelines if they don't feel that the deals are out there to be had and they're not good. But I think everyone that I talk to is absolutely looking under rocks at this point, because it's an opportunity for them to be out there and providing needed liquidity where they're in a pole position and they're not secondary to the banks right now.
Yeah, the banks sitting on the sideline it's a huge opportunity, and I think that that's consistent with what we saw in 2009. That the bank pullback really created an amazing opportunity for non-bank lenders, and I think that over the past 10 years, the bank lenders, in some sense, haven't given up the ground that they lost back in 2009. So I realize at this point everything is speculative, but if you wanted to take a moment and speculate as to what you think the mezz market looks like in a post-COVID world, David, do you think that we're going to see a return to what the market looked like in February of this year? Or have there been fundamental changes that are going to change the market in either a better or a worse way for mezz lenders once things go back to normal, whenever that is?
I think it's probably too soon to say, although my hunch is you won't see fundamental changes. I think things will tend to, level set close to where they were, largely because I think the dynamics in the middle market remained and the fundamentals remain unchanged, meaning largely demographically driven by aging baby boomer sellers who really don't have a succession plan. I don't think anything has changed the dynamic or decreased the supply of companies coming up for sell or refinancing. If anything, I think it's probably increased that supply or demand, depending on your perspective on it. And on the capital side, again, I don't think any capital is going to be returned to LPs. The banks will eventually become, get back to a level of activity. And I just don't think it's going to fundamentally change, kind of what we were seeing before. It might see a little relief on pricing pressure in the short term. And as Ann said, I think you'll continue to see at least, maybe see in the next year or so, similar pricing to what you were seeing, but with more senior-like structures. So, less risk, but, continue the pricing. So pricing the risk in through the company, not through the actual legal structure.
And what about you? Do you think that there's any fundamental changes that we'll see in a post-COVID world?
I concur with exactly what David said, that you will see a little bit more of a, senior structure, that you won't be seeing a lot of unsecured mezz, that's for sure. You're going to see, totally leaned up mezz that I think often is in a largely first lien position, has significant controls. I do think the market is going to move on intercredit or terms slightly. We might see those are pretty standardized at this point, but I think that in the last 2 years prior to COVID, I've seen additional pressure on some of the fairly established mezzanine secured kind of second lien terms, I think that pressure is going to be released a little bit. To give you an example, sometimes I would see first lien lenders and sponsors who were really driving the market. Borrowers were able to negotiate tremendously favorable borrower terms over the past several years prior to COVID. And there would be pressure on the standstills, moving it from the traditional 180 to 270s, or bifurcating the type of lender remedies that they could take at various times. So I think that pressure you're going to see come off to the extent they're not in a fully senior position in the cap structure. They're going to have a little bit more flexibility on their second lien and their security package. But no, I don't think the market is largely going to move in terms of what the product really looks like apart from the pricing. And potentially also, I think you may see some equity kickers come back into play where they've been very few and far between.
Yeah, it's going to be fascinating to see how things shake out. So we're about to wrap up. I just wanted to give both of you a chance. Do either of you have, last words of wisdom or some genius advice for somebody who's interested in the mezz space, or any particular interesting nugget that we didn't get to over the earlier conversation? David, I'll let you go first.
I think it kind of comes full circle. Ann mentioned that, I don't think we've seen any unsecured mezz. I think those, and this could be the whole nother podcast, but you're truly going to, if you're investing in the mezzanine finance right now, you have to realize that you're the fulcrum security. And I think unless you have an appetite or a willingness to step in and take control of a borrower on a downside, which, that's the nature of the second lien position the mezz is holding. And I think there's it's both a great value opportunity and it poses potential structural risk. If you have the DNA of your fund in order to do that, those might be some of your greatest returns in the fund, and the deals that wind up having to be restructured and you convert that mezzanine fulcrum position to an equity position. If you don't have the DNA or the ability to do that and play a sponsor role, then I think you need to be very careful for that the deals you're financing in, that it's both a long-term viable business and as importantly that the sponsor, whether it's a committed fund or an independent sponsor and their capital partners, have both the dry powder and the skin invested and the intestinal fortitude to continue backing that investment, because otherwise you could be in a little bit of a quandary.
Yeah. And what about you? Oh,
I was going to say, I didn't know that I'd necessarily had any words of particular wisdom so far, so I'm glad that you've marketed as if there have been. in terms of parting words, I think taking off from what David just said, I think one of the things that mezz funds are going to have to really consider hard over the next year is not only whether to fund additional liquidity, whether it's a worthwhile continued investment as opposed to throwing good money after bad, but there are going to be lots of opportunities for, that to be a very good follow-on funding and for them to, like I said, potentially get some equity. To David's point, in terms of potentially having to, outside of a bankruptcy, restructure, convert some debt to equity to get it right-sized a little bit more for the balance sheet, at least temporarily, which could then also provide further upside as the company does rehabilitate and, later may get sold. The mezz lender often steps into the shoes of, to the extent there's not a strong sponsor in place, really kind of starting to take on that sponsor role, certainly if they're going to convert a significant amount of debt to equity or otherwise take more significant control of the company. That's a typical kind of mezz restructuring playbook. I will fund this liquidity. I will roll some of and convert some of my debt to equity, but then I need to really be at the reins of this company to monitor my investment. And that works, and I've seen that work very successfully, but it's a very long-term play, typically, and you've got to be careful picking and choosing how many companies you make that play on, because then you get into, I think, what people will talk about as the 80-20 rule, that 20% of my portfolio takes up 80% of my time. It can be an opportunity cost sometimes. So I think that's the parting word of wisdom that I would say, is that being able to have that flexibility to make different capital investments, to alter your investment, and to be able to get more control over your investment is all a very big positive for these funds, but they're going to have to pick and choose.
Yes, I think that's great insight for both of you. Thank you both for joining and for the conversation today. That was a really fascinating dive into the mezz market and what we've seen so far and what we might start to see in the future. So thank you, David. Thank you, Ann. And I'll leave you to the rest of your day.
You bet. It was fun.
All right. Thanks,
All right,
Brian.
guys. Have a good weekend.
Appreciate it. Bye.
Thank you.
We appreciate you joining us on this episode of Yield Maintenance. If you have a question you would like to ask us or a topic you would like to have covered on a future podcast, please visit our website at McGuireWoods.com. We look forward to hearing from you. This podcast was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this podcast, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in the podcast. The views, information, or opinions expressed during this podcast series are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This podcast should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.